Hello, everybody. Good afternoon. My name's Minori De Silva. Thank you very much for joining this webinar today on October the 4th with Taylor English and Reed Financial and Powell and Edwards. Again, my name is Minori De Silva. I'm a partner at Taylor English here in Atlanta. And we're going to talk to you today about some common issues that employers encounter. And I'm very happy to have a fellow partner with me, Anne Schildhammer. She has over 30 years of experience handling commercial and employment issues, and she's a litigator as well. She has been a former general counsel for a top 40 building company in the US, and she is thoroughly experienced in defending employers and companies against very common issues that they come across. For example, things like overtime, restrictive covenant disputes, and discrimination. So without further ado, Anne, would you like to take the floor and we can start going through some of the issues that our listeners will want to hear about?
Thank you, Minori. I appreciate the introduction. As Minori indicated, I'm Anne Schildhammer. And the first topic that I'm going to discuss is the exempt versus non-exempt issue that we as employers hear about all the time. One of the things that I come across in my practice when I'm advising my clients is when we talk about exempt versus non-exempt, my clients tend to refer to sometimes as it being a salaried employee. And by the use of the word salaried, they believe that that automatically makes the employee exempt. That is a myth, and that's a common misperception that I want to address here today. So the Department of Labor is the governing agency that handles issues, and the Fair Labor Standards Act governs exempt versus non-exempt. And basically what it says is if you are a non-exempt employee, then you are entitled to overtime pay for all hours worked beyond 40 hours in a given work week. In order to determine if you have an exempt employee versus a non-exempt employee, you first have to get them across what's called the salary basis test. It's a threshold test. So in order for an employee to be exempt from getting overtime, they have to be paid a salary, a minimal salary of $684 per week, which annualizes out to $35,568 per year. And that's up from the level that was considered back in 2019. That was changed by the Department of Labor. And exempt employees is just that. It's an employee who is exempt from overtime pay or minimum wage. And basically they are paid a salary for any and all work that they do in a given work week, regardless of whether they might spend 30 hours on it in a given work week versus some weeks, maybe 45 or 50 hours. In order to have an exempt employee, you have to look at various exceptions that have been defined by the Department of Labor. And those are usually, they're called white collar type exemptions. And there's various white collar type exemptions. There's an executive exemption, there's an administrative exemption, professional, outside sales, an exemption for folks who work in the computer industry. So in order to become an exempt employee and to fall into that white collar exemption for not having to be paid overtime, they have to meet certain tests to qualify. And again, that first test is the salary basis test. They have to meet that threshold of that $684 per week in order to even qualify. The analysis has to go beyond that, though. You can't just stop and say, just because I'm paying an employee a salary means they're exempt from overtime. That is definitely not true. And if you do that and you've misclassified somebody as an employee, you can definitely have a lot of, be looking at subjecting to fines, legal fees, back pay, front pay, etc. So you have to be really cautious to make sure that you've got your employees classified correctly. You have to dig deeper beyond the salary. You have to go into what they call the job duty test. And typically the job duty test really boils down to whether they are in roles where they're giving and they're providing their own discretion, they're making certain management type decisions on behalf of the company, and also whether they're managing certain employees. So that's really where the test boils down to. To talk a little bit about non-exempt employees, like I said earlier, are going to be paid overtime. They get time and a half for all their hours worked over 40 hours. And if they don't, and if you're later challenged for that, the fines and penalties against the employer can be pretty great. Also, if you've misclassified an employee as being exempt from overtime and they're truly non-exempt, and you should have been paying them overtime all of these years or months or what have you, and you've not been keeping records of the number of hours that they've actually worked, that could be very problematic, because when something like that is challenged and you're not keeping those records, then the courts will look to the employee and base what they're owed on the records that that employee has kept. And so you can imagine that could be quite problematic for an employer if you misclassify an employee. Again, I talked about certain exemptions. There's the executive exemption, and that executive exemption applies to whether you're managing certain aspects of the enterprise. You are regularly directing the employment and the duties of at least 2 or more full-time employees. You have the decision and the ability to hire or terminate employees. That's really where the executive exemption falls. The administrative exemption would be, you have to be, again, compensated on a salary basis. And then your primary duty is the performance of office or non-manual work. That would be directly attributable to the management or the general business operations of a certain company. And again, in doing that, by using the word directing those types of duties, that employee is using its own discretion, his or her own discretion and independent judgment with respect to matters that have a pretty significant level of importance with the company. So we don't really have time in today's presentation to go into all the ins and outs of exempt versus non-exempt, but that's the very high level view of that particular topic. The next topic that I thought I would talk about would be the screen up ahead of you, or is the common overtime pitfalls of exempt versus non-exempt. And those are, we talked about what happens if you misclassify a worker. You want to be careful if you direct a non-exempt employee, somebody who is entitled to overtime. You need to make sure that your policies or procedures in your handbook says that they are not to work overtime unless they have previous approval or prior approval. Otherwise, you're going to get people working beyond, the 40-hour work week all the time, because that paycheck at time and a half looks very good to them. So make sure that your supervisors know that they are to tell the employee when they reach that mark, go on and go home. There is no more work for you to do. It is the employer's responsibility to dictate that to them. You don't want to encourage off the clock work when they are out, when they are done working for the day. You don't want to be sending them emails and having them respond to emails outside of the working day. That is compensable time, and you would be required to pay overtime for that. You also don't want to be sending mounds of work home for them to do for a non-exempt employee. Again, that's going to just be expensive for the employer, because they will be due time and a half for that work. Another common pitfall is forcing them to go to mandatory activities, so training outside of work. That all is compensable time for the non-exempt employee. And so it's extremely important to know that, and it's extremely important that you manage that effectively as the supervisor. I'm going to turn to independent contractors versus employees. That is independent contractors are used very frequently by many companies. And indeed, we're seeing a lot more of that as we go to sort of the remote workforce, which is the topic that we'll address next. So it is really important so that you don't run afoul of what the Department of Labor expects, what your employment taxes are, what the Fair Labor Standards Act imposes. It's really important that if you have true independent contractors, 1099 employees, that you have classified them correctly versus a W-2 employee. And you need to make sure you document it, because if it's ever challenged, they're going to look to you to prove that that employee or that contractor is indeed a contractor and not a true W-2 employee, and that you've not tried to skirt the law somehow by calling them a contractor versus a W-2 employee. And even though there was some, kind of back and forth amongst the different administrations at the end of the last administration and the entry of President Biden, everything now is back to what we call the economic reality test. And so the way we look at independent contractor status versus employee status is based on a 6-factor balancing test. And that's what the Supreme Court said. That's what we're going to do. We're still going to look at that to determine what is the true nature of a worker's classification. And those 6 factors are, and they're summarized here in really 3 different categories, 3 areas that are a part of that 6-factor test. It's the behavioral control, the financial control, and relationship of the parties. The first is you really look at the nature and the degree of how much control an employer, the company, has over the person doing work. And so if the company has a good bit of control over the person doing work, then that person is probably going to be an employee. On the other hand, if the company gives the contractor or the person a lot of discretion in their working hours, in where they're going to work, what time they're going to work, etc., that's more of an independent contractor relationship, and that will be scrutinized if it's ever challenged, and that's the nature and degree of the control. You also look at what's the permanency of the worker's relationship with that individual. If you've got someone who's doing contract work for you and they're doing work for other employers or other businesses, that's typically a contractor relationship. If you've got one person that is exclusively doing your work and you're controlling that work, it's typically a W-2 employment relationship. You also look at who is actually providing and paying for the the equipment, etc., that is used by the worker. If that equipment is paid for by the employer or the business, again, typically an employee relationship. On the other hand, if it's paid for by the contractor, it's typically a contractual engagement type relationship, as it would be for a 1099 contractor. So that's really the behavior control. You also look at whether there's real expertise and skill and judgment that goes into that relationship. The courts have looked at, if it's a contractor, it's usually of a special nature. It's usually not somebody that just has a general knowledge of everything. It's usually somebody that you're engaging with because of their particular expertise. And then you go to financial control, that's whether that worker has a risk or benefit by virtue of the work that they're doing. And then the degree of the integration of the services to the employer's business. So that's really those are the tests. That's the general categories of your contractor versus employee. As a litigator, I've litigated these types of cases, and I've also handled challenges brought about by the Department of Labor. And the first thing that the Department of Labor is going to ask you for if you have a contractor relationship and you're not paying employment taxes for that person, contractor is a 1099 person, and that person is typically responsible or always responsible to pay their own taxes. The Department of Labor, if that is challenged, is going to come to you as a company and say, first and foremost, show me the written agreement that you have with that contractor. So I would highly recommend that you make sure that you have a written agreement with your contractor employees that sets out, maybe not in great detail, but certainly touches on some of those factors that we just discussed, so that you can prove that the relationship you have is of contractor versus that of an employee. So Karen, can you pull up the next slide, please? Okay, so last topic that I'm going to address, again, moving through these fairly quickly, is as everybody understands, we are seeing much of remote work going on. Since we had the pandemic last year and we're still in the throes of that, we're seeing a lot of companies that have gone remote and are staying remote. This poses a lot of issues for employers. It can be good. We're knowing that employees are wanting to work remotely. They're saying they're more productive in that realm, but there's certain things that an employer has to be aware of. First of all, it can be fairly expensive to make sure your remote workforce is up to speed and has everything they need at home. You also, back to the overtime issue, you have to make sure that your remote workers who are non-exempt from overtime are only working the hours that they should, or your overtime expenses are going to go up drastically. You have workers' comp issues that you have to deal with. Just because they're working from home does not mean that you would not be subject to a workers' comp claim in the event that there was an injury on the job and at home as they're working from their home office. You also have to look at certain ADA, Americans with Disability Act accommodations for that remote worker. If you do have a remote workforce, you need to have policies and procedures in place where everyone is treated consistently with respect to their position. You have to have your defined job descriptions in place. And again, you need to have your remote work policies in place as to, is it full-time remote? When do they have to be, check in to make sure they're doing what they're supposed to do? So to keep track of that, it's very, very important that you have those policies in place. So with that, I will end my portion and I will hand the baton back to Minori, who's going to talk about a few other topics.
Thank you very much, Anne. I appreciate that. So I wanted to just touch on some hot topics that are going to be relevant for many employers this year and beyond. There are various states that have looked at increasing the minimum wage, which has remained stagnant for very, very long time, years and years in most states. So this is something you need to bear in mind, especially if you have any employees who are outside the state of Georgia. This is something that is going to be talked about. It's very much on people's minds about equality or fairness, etc. Whatever you think about that position, it is something that's going to be talked about a lot. And in that same vein, there are more and more states that have started to implement some kind of paid sick leave, even if it's relatively nominal at this point. That's another thing, especially with COVID happening. I expect that discussion to carry on and not go away, even in the state of Georgia. Some of you may have heard about this notion of gig workers and folks working for Lyft and Uber, etc. There is likely to be, with this administration, more of a scrutiny on how are those gig workers treated if they're not treated the same way that employees are treated. And so hand in hand with that is that this current administration is going to be more likely to investigate things like misclassification of folks as independent contractors when they're actually really employees, and should this person have been paid overtime, just like Anne said. But it's more likely to happen in this current climate with this current administration. Also, there is just because of the prevalence of social media, and we have, you know, a younger working force that's coming of age as managers, etc. There is just a much broader awareness of the notion of discrimination in the workplace, and I put it there to the, you know, the Me Too movement and other social issues. So those are things where if you have a diverse staff, and it includes younger folks, just be aware that there is you know, you're not going to be able to hide under the table and ignore these branding issues that you have to think about. And so it really is important for you to start thinking ahead. How do we tackle things like, you know, political statements or political debates in the workplace? How are we going to address if somebody wants to work from home, because that's also something that people are talking about a lot. There are just a lot of different priorities that millennials and you know, the younger generations are interested in. So you don't want to be on the back foot, where if you want to hire those folks as part of your team, that you haven't thought about the things that they care about. It's very clear, we know from data that's been looked at already, that the younger generations, millennials and younger, are going to be the biggest, you know, block of workers, biggest voting block, and they simply do have, I know there's differences between individuals, but as a block, they have different priorities. So thinking about flexible working, thinking about, you know, how do we deal with a diverse workforce, you need to start thinking about that now. Karen, would you mind going to the next slide, please? Thank you. So before I just end my section, I did want to just flag two other things that are very common myths in the employment field. One is that, you know, somebody's at will, you can fire them anytime for anything. That's mainly true, except there are some prohibited reasons, mainly to do with discriminatory conduct, that you'd fire this person, but you didn't fire this other person who pretty much did the same thing. So don't believe that just because somebody is at will, that definitely means you can immediately fire them, no problem. The second point I wanted to make is that we sometimes do hear that folks think if it's not in writing, then it's not enforceable. There's no contract, in quotes. Verbal promises can be binding. So be careful when you have managers making promises to employees. Some of that can come back and bite you if you don't understand that what you've actually done is create a legal obligation. And so before I just end my section, I did want to have as takeaways that this is a time of flux. Expect with this administration that it's going to be a more employee focused approach from the federal government. And you know, I've put this as perspective can help. I'm European, I grew up in Europe. A lot of the things that you see in some pockets of America have been going on for decades in other countries. And there are also places within America where this has happened. So what you might hear in the media is not necessarily as drastic as it could sound, because some of these experiments have already been taking place in America. And that's why I refer to the talk about the minimum wage and the sick leave. And lastly, as I put on the bullet points, this is a time of change and it's inevitable, but we would rather, as counsellors, help you be prepared for what's coming around the corner than have you in a position where you have employees leaving because they don't like your priorities and they're not attracted to you as an employer anymore because you're not aware of how the demographics are changing. So that's all for me, and I'm going to hand it over now to April.
Thank you so much for that, Minori, and thank you, Anne, as well. What a wonderful, timely information. So thank you so much for your time on that today. We are going to shift a little bit now and talk about some areas where employers, particularly small to mid-size business owners, often have areas that are overlooked that can make a pretty tremendous impact on their long-term planning. The first thing that we have to talk about, we're going to focus both on retirement and exit planning strategies. Then we are going to have Nathan Powell join us in just a moment and speak about some potential legislation changes that could have some tremendous impact on all of this as well. But the first is, before we can get started with any sort of planning on retirement or exit strategy, is we have to have some parameters and some definitions. We need to know what the plan is so that we know where to begin. And when we talk about defining ideal retirement, that's going to look different for everybody. And, you know, there was an old commercial that everybody in the commercial was walking around with a gigantic number under their arm, and it was the "What's Your Number" campaign. And I think a lot of times people do think that way. Sometimes with small to mid-sized business owners, however, they're really relying solely on their business to be their retirement plan, and several mechanisms have to be in place to make sure that that is going to be a fruitful part of retirement, but certainly not the exclusive planning. Let's see. The second is exit strategy, because a lot of times we don't see sufficient planning in this area. Abby is going to speak with us in a moment about a particular aspect of this, both during the active years of working and during the transition phases. But when we're looking at an exit strategy, we're talking specifically about a succession plan. Sometimes with small to mid-sized businesses, that will be in conjunction with family members who are part of the business. Other times there has to be a different succession plan. But what we find is that approximately 1/3 of retirees who have a small to mid-sized business that they run really don't have a retirement or succession plan, and they're relying solely on selling the business in order to exit. It's very critical to have a proper valuation and have proper documentation in place as well. Nathan will speak some to this in just a moment as well, but in making sure that if something happens to a business owner prematurely, that there is a foundation in place that's not just retirement oriented, but oftentimes it can be very difficult to sell a business if there isn't a clear successor, if there is not clear documentation, and if there isn't a valuation that's already done on the business while that business owner is still living. So a detailed timeline on what those objectives look like, but careful and thoughtful planning along the way to make sure that employees as well as intended successors are taken care of. A defined savings plan, making sure that there is a strategy for setting aside sufficient funds to supplement potential sale of a business. A lot of times we will see people transition into a consultant role where they have less expenses, less responsibility, but they do still work for a while, and having a strategic income strategy. So what does that look like as far as savings, if that is part of that transition? Tax diversification is a very important aspect of this as well, because a lot of times what we find is that people will contribute everything into qualified retirement plans for their savings. And when they do that, they're deferring all taxes into the future with the premise that taxes will be lower in the future. And certainly in the environment that we're in today, that might not always be the case. So proper diversification between the various tax designations as well as investments, and then lazy money and cash purchases. So this is a two-pronged part of this conversation, that a lot of times what we find with business owners is that they're very cash heavy. And that can be with reason. That can be because expenses are high, but oftentimes they're too cash heavy and have an area where they're falling behind to inflation. There's just not a strategy there with the extra savings that are not needed to cover expenses. We call that lazy money. So having a strategy in place there so that you're not constantly falling behind inflation. And then cash purchases are another area that I do want to mention, because often we see that small to mid-sized business owners make a lot of purchases outright. And that's not, in this interest rate environment, that might not always be the most prudent thing to do. It's good to work with a CPA on this sort of thing as well, to make sure that we understand the full impact of how we're making those purchases. And along the way with this planning, making sure that there's sufficient contributions to programs such as Social Security. Oftentimes we see people who are business owners retiring with a very minimal Social Security income because that type of advanced planning has not been done. So it's important to maximize that income source. And then I'm going to transition here in just a moment to my sister and my colleague, Abby Reed, and she is going to talk about the importance of the various types of life insurance when it comes to business owners. So Abby, I will turn it on over to you and let you take the floor.
Thank you very much, April, and thank you to everybody that's on this call today. It's an honor to be on with everyone here. Anne and Minori and April have just discussed some. Oh, I'm getting a little bit of feedback. Hopefully, I am coming through okay. They've just discussed some amazing ideas on how to protect us as business owners, our business, and also how to help our businesses thrive in the current environment today. I know that Nathan's going to talk about some recent and soon to be legislation that's also business oriented. So we'll get some great content from him as well. So another aspect of protecting a business is insurance. So we have, the health insurance and disability insurance, which isn't as overlooked in what we see as life insurance is. So life insurance is really a building block and a fundamental of any business. And it can be used in several different ways. So obviously the main way that most people see is using it as protection for your family. So that's going to come in the way of a death benefit for your family. What we see a lot of times, we work with a lot of business owners, and sometimes this is pushed to the back burner. It's not a fun topic to focus on, but it really does need to be in the forefront. We see a lot of business owners, family businesses even, that are really thriving. And as business owners ourselves, April and I, we know that businesses take 100% of your time, it seems like, a lot of the time. So this can be pushed to the back burner. But the number one thing we would recommend doing is making sure that your family is protected. So if something happens to you much sooner than is expected, that your family will have enough income to make other plans. Hopefully there's a succession plan that's already in the works that can then pick up when something happens. But also, if that plan is to sell your business, then it's going to give your family enough time to sell it in a effective and efficient manner. So what happens sometimes if there's not life insurance in place for the business owner that passes, the family is forced to sell the business really quickly because there's just not the income there anymore. There's not the profit there anymore to sustain the business. So they have to go out and sell it really quickly. And oftentimes that's going to lead to a business being sold at less than it's really worth, which is obviously not ideal. Also, it might not be, in a market cycle that is very advantageous for selling a business. So with the life insurance, with the death benefit, it's going to give your family enough time, enough runway to sell the business when it's the right time, or potentially find somebody that can maybe step in if there hasn't already been a plan for that, and go ahead and pick that up and start to run that business themselves. On that note, there's another way to use life insurance that maybe you've heard of before. It's a buy-sell agreement. And this is used most often with partners in business. So what happens with the buy-sell agreement is essentially both of the partners have a life insurance policy on themselves, and the death benefit would go to the other partner if one of the partners passed away. So that partner could then pick up and really run at full steam without losing too much time if one of the partners does pass away. I've also seen this done. We've also seen this done with people that are in similar industries or the same industry. So you might not be partners per se right now, but you would be comfortable with that person taking over your business, helping your clients, and making sure that there's no lag time there if something does happen to you. So that's another way to use this type of a buy-sell agreement to make sure that there's a plan. If something happens, there's a succession plan. If something happens to you or to your partner. Now, if we flip over to employees a little bit, there's also key person insurance. So that can be used, often is used for the owner, the founder, and the executives in the company. But it can be used for any employee that you have essentially a vested interest in that would cost the business money essentially if something happened to them. So in my life and my business, I can think of the employees that are absolutely crucial to our business, and they would be candidates for key person insurance. This can be structured in two different ways. So the death benefit could go to your business, and that would essentially be to help your business go out and recruit somebody that could take their place, train that person. The key person in our company or your company could have been there for 10 years. So that's going to take some extensive training and time and money to get that person up and running. So it could help cover that. And it can also be kind of a split. So it can go, some of the death benefit could go to their family and some of it could go to the business as well. So it could kind of be a split interest there in certain circumstances. Let's see. So this can either be done with term insurance, but more often it's done with permanent insurance. And so the benefit to permanent insurance is that it's not just a use it or lose it. Let's be honest, nobody wants to use life insurance because you have to die in order to get the benefit, which isn't very much fun. So with permanent insurance, there's a cash value that can build up within that policy. And that can actually be used if the business is an owner on that policy. It can be used to take tax-free loans out, and that can be actually spent on your business. It doesn't have to go to that person because the business is the actual owner of that policy. If the key employee is the owner, then they could use that if you wanted to potentially recruit or retain employees in a different way than maybe some of the big corporations do. A lot of times what we see is, 99% of large corporations offer term insurance to employees. So something that maybe smaller businesses could do is offer something a little bit different. So permanent insurance, life insurance rather, that has that cash value that can build, that maybe they can use for even their retirement. So it's maybe an alternative to a 401k or an IRA, or not even an alternative, I would say in addition to those retirement vehicles. They could take tax-free income in retirement as long as they, do that properly, or they could take out a tax-free loan to, maybe help pay for college or whatever expenses they have. So that's something that can be offered by smaller businesses that I haven't seen a lot of offered by corporations. And also right now we're seeing a lot of the concerns for even our younger clients is long-term care. So we know that we're living longer and the healthcare expenses can be exorbitant, especially as we get older. So some of these more permanent life insurance policies have a long-term care rider is what it's called. And what we see from our business employees, our business client employees, is that this is a huge draw. So if you're looking for something where you can go out and say, hey, this is something we offer that you're not going to see the corporations offer as kind of a recruiting tool, you can say, we offer not only the traditional life insurance, but this can also be used for long-term care expenses in the future, which is a huge thing for employees right now. So that's kind of a different way to look at this as not only a recruiting tool, but also a retention. You can help pay the premiums, or you can pay the premiums entirely for your employee. That would be counted as wages for them. And sometimes there's tax deductions for the business. That kind of gets into the weeds a little bit. So I don't want to get into too many details, because you can structure it differently. But there's just a lot of opportunity here for not only business owners, but your employees as well. So thank you for your time. I want to introduce Nathan. Nathan is a great partner with Reed Financial Group. He is a attorney and partner at Powell and Edwards, where he specializes in estate planning as well as business planning. And he's going to talk to us about some current events and some things that are maybe coming down the pike that we all need to really be aware of. So Nathan, go ahead and take it over.
Thanks so much for the introduction, Abby. I appreciate it. Let me share my screen real quick. I have prepared a PowerPoint here on one of my favorite subjects, which is estate planning. This is not only my business. It's a personal endeavor for me. The way I like to start talking to people about their estate plan, because it to me, I have a tendency to back up and be very egg-headed about the tax implications and how those pieces all fit together with your business plan. But most of all, it's a personal effort to plan an estate. So I want to introduce you real quick to frame up where I'm coming from here. These are members of my family. Top left is my son, Jonathan. Bottom middle is my daughter, Finley. My wife is down there in the bottom left. That's Carrie. And then my dad is the bottom right. Mom is in the top middle. And that's her holding my son, Jonathan. We have a new baby on the way. You can kind of tell that Carrie's pregnant there. We've got a new one due in January. And just to tell you how seriously I have to take this part of my job, this planning part. My mom and I were on the phone in around Christmas 2019. We were talking about what we're going to do for Christmas, how we're going to get the family together, and talking about our business. My dad and I are law partners together. So we always talk, business and family kind of fit together easily for us. But we were talking about my daughter's Christmas presents that year. She and mom are best friends, and mom had told me that I definitely needed to get a remote control car for Finley because she enjoyed playing with them so much. And that was the last time we spoke. Was that conversation a little less than 2 years ago. She was crossing a sidewalk and was hit by a car later that night. And so I know firsthand that things happen that are unpredictable, that affect your life. It happens to all of us, maybe not in so sudden a way, but sometimes it is that sudden. And if it had been Dad, I'm not sure that at that time our plan was as buttoned up as it should have been, even though I do this for a living. So to Abby and April's point, Mom had a life insurance policy through the Georgia State Bar that really made it easy financially to move into the next chapter of our lives together. But Dad is uninsurable, so the insurance company didn't think that Dad was going to make it long enough to deem him an insurable interest for them. So I don't know how long I have with Dad, and so this planning part of my job, how I help people, is personal on several levels. So our firm is Powell and Edwards. We're in Lawrenceville. And my job today and the little time I have is to give you the tools that you need to grapple with this planning process or personal and professional level. So the illustration that I came up with thinking about the theme of my part of the talk today is taking control of your plan. And as a dad, almost 3 times over, the joke about this picture is when I look at this, I see the beautiful trees and the landscaping and the chairs and what all, but all I can think about is that door's open, it's letting all the air out. And that's a unintended consequence, maybe. But I don't like things happening that you wouldn't choose to have happen if you have a choice. And we know that everybody's got a plan for us and our resources other than our plan. And the best example of that is really it's the phone, how your phone will suggest ads to you. So I watched a Netflix documentary not too long ago, and in the documentary it was about social media, and they said that if you don't have a product, if you don't know what the product is on an app that you're using, then you are the product, and you're being sold information, advertised to all the time. Everybody knows that wakes up and checks their phone. The first thing you get hit with if you open YouTube or I don't know, any website, it's, hey, buy this. So we all love our iPhone, but we don't love being sold to 100% of the time. And what that does is it redirects our resources away from where we would choose to put them to a place where other people would choose to put them, which is my job to prevent that, even though I'm a quieter voice than your iPhone. So I made up a nightmare to illustrate this point in a little more graphic way. I want you to imagine you're standing on a boat dock, and there's this sailboat, and the sailboat captain looks to you and says, "Hey, where do you want to go, and how do you want to get there? Let's chart this out. I'll put the map out on the boat, and we can draw with a crayon. You tell me where you want to go and how you get there, and I'll help you along the way." And then cruise ship captain's on the other side of the dock, and cruise ship captain says, "Hey, just get on, and I'll tell you where we're going to end up once you get on the boat." And that's my illustration. I don't want to pick on the government necessarily, but it's the government, it's big business, it's whoever has a plan for your assets and your resources other than you is supposed to be the cruise ship here. Don't pay attention to that name on the side of the boat. So I wanted to talk about current events for just a second here, because they're important for business owners to hear about. There's a lot that affects our discussion today that's on the table as we speak. There are 2 bills circulating in the House of Representatives and the Senate. This is the federal legislation. We've got the infrastructure bill and the reconciliation bill. And the reconciliation bill has gotten tied up. They've set a couple of deadlines to vote on these bills, and they're tied together because the left and rightmost sections of the Democratic Party are trying to package them together to kind of force the party to agree on their priorities and get both pieces of legislation through at the same time. They're afraid they'll lose the left or the middle if they pass one without the other. So as of this morning, the deadline is the end of October. This is 2021. So we'll see how this goes. But the reconciliation bill, what it does is it allocates money. So you saw the $3.5 trillion number. That number may drop. President Biden said this weekend that he expects the final number to be somewhere between, I think he said 1.5 and 2.2 trillion. But still a lot of money. And the infrastructure bill that all parties agree on, I think 15 Republicans would vote for that. And it's $1 trillion. So total, all in, we're talking somewhere between 2.5 and 3.2 trillion dollars worth of money that the legislature's trying to inject into the economy. What this will do, it allocates money to a bunch of social programs, education, climate change, war. Well, I shouldn't say it that way, but climate initiatives to try to control global warming. education, allocating money to historically Black colleges, and then universal pre-K, which is something that should appeal to me with all my kids in preschool age. And also allocating a significant chunk of money to enforcement. So the IRS is getting hundreds of billions to fund enforcement actions on their part. So the questions that business owners ask me are, who's going to pay for that, and where is the money going to go? And this is a little ham-handed, so forgive me, but it's you if you're wealthy. So business owners are actually being targeted in the reconciliation bill. They're raising taxes on people who make a lot of money and who are wealthy to pay for the social programs that are laid out in the reconciliation bill. So where's the money going? Who knows? But not where you would put it. Now that's a little unfair. But the way this legislation works is that they're allocating money. The bill actually allocates money for certain purposes, but doesn't prescribe exactly how that money is going to be spent. So if you look at the language in the bill that's being proposed, it says this money is to be allocated really to an administrative agency to oversee, in hopes that as the money funds over the next 10 years is the time horizon for the application of this bill. The money will be used for the purposes for which it's intended, but the enforcement mechanism isn't necessarily there. So as usual, there's not a lot of transparency when it comes to how the government uses their money. Certainly not as much transparency as there would be if we had the ability to sit down and draft it for your piece of the pie. So what you have to put in, where would that money go? And that's really my job as the planner, is to make sure that your resources go where you want them to go, and the way that you want them to get there. So the reason I put this slide up is because the title, this is an internal Ways and Means memo, and it says responsibly funding our priorities. And that just stuck out to me as being right on point. It's not your priorities, it's our priorities that really count here, meaning the legislatures. Okay, how certain is this to pass? It's pretty certain that it's going to pass sometime by the end of the year. I think that's fair to say, even though it's stalled several times in the last couple of weeks. But here are the effects, and these are among several effects that this bill will have on certain of our clients. The unified credit amount, the amount that every American citizen can give away tax-free, is dropping from $11.7 million in 2021 to $5 million is the proposal as of 1/1/22. So January 1st, 2022, we expect the unified credit to drop to $5 million from 11.7 per person. So small business owners often have a higher net worth than they think they do, because the value of their businesses is greater than they think. Particularly, they've done a good job setting it up, as my panel mates have described. Trusts, so certain types of trusts, a grantor trust, to the extent they're funded or created after the date the bill passes, they will be included in the grantor's estate, no matter whether or not they would have been that same trust would have been included in the estate prior to the date of passage of the bill. So the way I describe that to clients, because it's technical and tax oriented, is to say that if you have a trust that you intend to avoid the estate tax, then you need to take a look at it, preferably before the bill passes, so that you can determine whether or not you need to make some tweaks to move it outside of your taxable estate. Discounts on small business interests forbidden. That's also a little too broad. What that means is that if you have a passive business, so if you own, say, a piece of real estate that pays rent, in the past, small business owners have been able to discount that interest simply because it's inside of a business or inside of a trust. You can put restrictions on transfer in the governing document that prevents the asset inside of the company from being valued at its highest number. And that tool is disappearing with this piece of legislation. So in other words, the assets inside of a passive company will be valued at 100% of their fair market value. So I think April was talking about getting appraisals done for companies so that you know what's in your estate, you know how to plan correctly for that asset. That is doubly necessary if this bill passes. And silver lining, the step up in basis will stay. So some of us were concerned that that the tax basis would be a transferred basis instead of a step up basis at the date of death. If you want a more detailed explanation, I'll be happy to give it to you in another setting. But bottom line is there's a big tax advantage to holding appreciated assets until the date of death and transferring them at the date of death for the beneficiaries anyway. So you avoid capital gains tax on those assets. Okay, so take control of your plan to the extent you can. Don't get on the cruise ship. Okay, now the basics of trust and estate planning. This is really business succession planning, but I'm going to deal with the personal things first. What we start with in our office every time we have a signing appointment is an advanced healthcare directive, which governs healthcare decisions while our clients are still alive. So while you're alive, you need someone who's able to step in and make healthcare decisions for you. That's what a healthcare directive does. A financial power of attorney does the same thing for financial decisions. So it allocates responsibility and authority for making and communicating financial decisions while you're still alive. And next are the will and the trust. So wills and trusts work together for purposes of dividing up your stuff, allocating responsibility and authority for managing your assets after you die or after you become disabled. For small business owners, we often recommend trusts, not always, but often, because they give you some flexibility that's not otherwise available. So we'll talk about that in just a second. But when you're determining what's in your estate, meaning what's subject to your will's instructions, those are probate assets. So probate assets are generally individually owned assets, including real estate, financial accounts, probably a car. Personal effects fall under your probate assets too, although you can move those into a non-probate realm by using a trust. Non-probate assets are those under April and Abby's control, such as IRAs, 401ks, payable on death accounts, and life insurance. So anything that transfers automatically at the date of death is a non-probate asset. So particularly in relationship to businesses, and April and Abby touched on this earlier, but I'm going to bring it back up. We've got business succession. So try not to be distracted with this slide. I know it's a good slide, but the bottom line with business succession is that what we're trying to do as business owners who maybe have partners or have created this valuable asset while we're living is we want a seamless transition of control. So the easiest way for me to isolate that to a really relevant point is if a contract needs to be signed or payroll needs to be met, and you as the business owner are not able to sign that check for one reason or another, mentally or physically, you're not able to make payroll, you're not able to close on the real estate transaction that needs to be closed, who's going to step in and do that for you? And you can see that if you haven't made that plan, it's not something that comes up every day, but when it does come up, it hits pretty hard. Many people don't look at that, and it can cause a bunch of problems. So I brought up Wrong Way Corrigan because he illustrates my point. Wrong Way Corrigan got that name by taking a plane, I imagine, like the one behind him, if not the one behind him. He meant to fly from New York to California, and instead he flew from New York to Ireland and landed in Dublin. He went 3,000 miles in the wrong direction. And I thought that was poignant because that's often what business owners end up doing. It's not on purpose, not because they wanted to end up in Dublin, but just they haven't made the plan, they haven't looked at the map, they haven't thought through all the complications, all the responsibilities they have day to day, and how to give those away. So that's what we try to avoid. And the way we do that, generally, like I said, with business owners, we often use trusts. in conjunction with the governing documents of the company. So the company, the governing documents, the reason the bank needs to look at those in order to open a bank account for the company is so they know who has signing authority, who's the manager, who's the secretary, who's able to make decisions on behalf of the company. That's what the governing documents do. And if you have a trust that junctions with the governing documents, the trusts often hold ownership of the company, or they receive ownership from your estate. And then you have a unified plan between the governing documents of the company and the trust that hopefully work together and leave no room for question when it comes to who makes payroll and who signs contracts on behalf of the company. So that's my goal. I love it when things move smoothly and people end up where they want to go and there's no loss of value. But you can see how much trouble it would cause if there is no plan, because things get lost and there's a time value of a company. If you create this asset and then you can't make payroll, your employees start to jump ship, and then everything you've created can disappear in a matter of time. So if you're not there to hold it together, who's going to do it for you? That's what we're trying to fix. So the role of trusts are in a contrast to a will. Wills are public. If there's a complicated family situation, they invite objection from family members. They take months to transfer authority, whereas trusts are private, discourage objections because of their privacy, and they result in immediate transfer of authority upon death or disability. So wills and trusts protect the vulnerable. They make a plan for maybe your widow or your kids or your other family members who would take over the business for you, your key employees. Those people will be in a vulnerable state without you there to protect them and make decisions. Having those documents in place protects those people by giving them a plan so that when they're grieving or lost or confused or whatever they're going through, if you've taken the time to lay out for them what needs to be done to preserve the asset that you've created for their benefit, that helps them deal with that difficult time in their lives, one that I've been through personally. It provides the plan, so protects the vulnerable by providing the plan, you might say, and preserves your legacy. So each of us business owners, we get up in the morning and we and that day we stand for something. So every day it's like cards. You're laying one on top of the other, and at the end of your life, you're looking at a picture of everything that you've valued, everything that you've contributed to society, to your family. That is your legacy. So people often call me and say, I need a simple will. No will is really simple. Everybody's family situation is different. And depending on how they work and what they invest in, their time and money and energy, that is their legacy. So wills and trusts and business governing documents should line up with how you spent the rest of your life to preserve the legacy that you've created. So what I'd hate the most is if you spent all this time doing day-to-day work, and then at the end of it all, there's something that gets missed that results in a waste of value or a fire sale of assets that you helped to attain or create, that would undermine that legacy or cast a shadow over it. We just don't need that. So I encourage you to take control of your plan and make wise decisions. Think it all the way through, and look again at your governing documents and your personal estate plan. It should work together to preserve your assets and make a great business succession plan. So thank you for your time here. I'm going to turn it back over to our other presenters.
Thank you so much, ladies and gentlemen, for joining us this afternoon. If you have any questions for any of the presenters that were on our panel today, please do not hesitate to reach out to us individually, and we are certainly happy to assist you in any way that we can. And also keep an eye out, because as Nathan indicated earlier, there are certainly many potential changes on the horizon in the very near future, and we are going to do the very best that we can to keep you in front of those. Thank you so much and have a blessed day.